While the White House claims the Middle East conflict is winding down, a physical blockade in the Strait of Hormuz severed global energy supply chains. The Strait of Hormuz is a narrow waterway, just 21 miles across at its narrowest point, that normally carries roughly 20% of all global seaborne oil. Iran has effectively closed the strait to American, Israeli, and Western shipping. U.S. intelligence confirmed the presence of limpet mines in the water, while GPS jamming creates severe navigation risks for tankers. Because of this, maritime shipping insurance premiums have quadrupled, adding $250,000 in costs for a single transit. This physical blockage has restricted the flow of energy worldwide. The crisis is so severe that a record 400 million barrel release from international strategic stockpiles failed to stabilize the market. This chart shows the price of Brent crude oil, which is the leading global price benchmark for Atlantic Basin oil, used to price 2/3 of the world's internationally traded crude. Before the war, it sat around $70 a barrel. When U.S. strikes were threatened against Iranian power plants, the price violently spiked to $119.50. The White House then announced a 15-point peace framework and paused the strikes. Following that announcement, the price crashed 13% in a single session, landing at $99. But Iran publicly denied that any negotiations had taken place. As military strikes resumed, the price climbed back above $101, and financial analysts at Goldman Sachs project these elevated prices could persist through 2027. Other financial sectors echo this data. Both the bond market and the maritime insurance market are pricing in a prolonged conflict with no defined end date. The collective financial data rejects the White House's claims of an imminent ceasefire. Traders, insurers, and bondholders are pricing in a war that continues to escalate. The military reality on the ground confirms the market's fears. The U.S. is currently deploying an elite ground force of between 6,000 and 7,000 troops to the region, including soldiers from the 82nd Airborne Division and Marine Expeditionary Units. Multiple defense analysts identify Karg Island as the most likely operational objective. Karg Island is a highly fortified landmass 16 miles off the Iranian coast that processes the vast majority of Iran's oil exports. Published military assessments outline a clear operational concept. The Marines will establish a beachhead, allowing the 82nd Airborne paratroopers to drop in, expand the perimeter, and hold the territory. If U.S. forces seize or destroy the infrastructure on Karg Island, Iranian supply drops out of the market entirely. That specific action guarantees another immediate and massive price spike in global energy. These global supply shocks have immediate consequences for American consumers. The national average for a gallon of regular gasoline reached $3.84, a steep climb from the $2.98 average before the conflict began. The broader economic shockwaves extend beyond the pump. The 20-year U.S. Treasury yield spiked to 5% within 24 hours of the peace announcement falling apart. The Treasury yield is the return on investment paid by the U.S. government on its debt obligations, and when it rises, it directly drives consumer borrowing costs up, pushing average mortgage rates towards 7%. Voters are responding to this sustained inflation. Widespread disapproval of the war and its domestic financial fallout has driven the president's economic approval rating down to a record low 29%. American consumers are bearing the financial burden of a war the administration claims is winding down. As long as the Strait of Hormuz remains contested, that burden will continue to grow.